21-1 accruals. So chapter 21 is only 2 sections, but if you look, we have 6 learning objectives for this first section. So that's kind of a lot. We need to be able to record the reversing entry for accrued revenue. We need to be able to record an entry to receive payment on a note receivable with accrued interest. We need to be able to calculate accrued interest expense. We need to be able to record the adjusting entry for an accrued expense. We need to be able to record the reversing entry for an accrued expense, and then we need to be able to record an entry to pay an installment on a note payable with accrued interest. So accruals. An accrual is an entry recording revenue before the cash is received or an expense before the cash is paid. So they give us 2 examples. Interest income is earned each day, but is recorded only when the interest is actually received. A note payable incurs interest expense each day the note is outstanding, but the interest may not be paid until the note's maturity date. So a revenue expense that is recorded at the end of a period, cash is received or paid in a future period. That would be an accrual. A deferral is an entry recording the receipt of cash before the related revenue is earned or payment of cash before the related expense is incurred. So examples here are rental income is received before we actually earn it, or a rent expense is paid before we actually owe it, before it is incurred. So cash is recorded when received or paid. When we have a referral or a deferral, revenue expense is recorded in a future period. And a reversing entry is an entry that's made at the beginning of one fiscal period to reverse an adjusting entry made in the previous fiscal period. So here we're looking at our interest income and our interest receivable. So there was that adjustment that was made on December 31st, about $175. And then here we see on January 1st, there's that reversing entry of $175. So here's what it will look like in the journal. We see our adjusting entry here from December 31st. We are simply going to do the exact opposite of that adjusting entry. Okay, so label reversing entries. We're going to then debit interest income, credit interest receivable. Collecting a note receivable with accrued interest. So on January 30th, we received cash for the maturity value of a 90-day 7% note. The principal was $15,000 plus interest of $262.50 for a total of $15,262.50. Receipt number 948. So we're receiving cash. We're going to debit cash for the total amount. We're going to credit our notes receivable for the principal of the note. And we're going to credit our interest income for the interest that we received. We're going to put that into our cash receipts journal because we are receiving cash. We're going to credit our principal to the notes receivable. We're going to credit interest income. And we're going to debit cash for the amount that we received. Analyzing an adjustment for accrued interest expense. Accrued expenses are expenses that are incurred in one fiscal period, but they're not paid for until a later fiscal period. So when we say incurred here, it means that we have that expense. However, we did not pay for that expense in that same fiscal period. At the end of a fiscal period, an accrued expense is recorded by an adjusting entry. The adjusting entry increases an expense account. The adjusting entry also increases a payable account. Interest incurred but not yet paid is called accrued interest expense. So here is the formula that we're going to use to figure out our annual interest expense. We're going to take our principal amount. So in this case, we have $106,625.67 times the interest rate of 8%. times the fraction of the year. So this is 30 days over 360. The annual interest expense then is $710.84. So here we're going to increase our interest expense with a debit, and we're going to increase our interest payable with a credit. And we owe that interest. So here they are just showing us what that's going to look like. Here's our long-term notes payable that we have. Our interest expense right now is $17,000. We're increasing that interest expense. Okay, and then here's our interest payable. We owe money on interest. Reversing entry for accrued interest expense. We're going to just do the opposite, remember? So we're going to credit interest expense and we're going to debit interest payable. This will be labeled as a reversing entry. Debit to interest payable, credit to interest expense. The effect of not using reversing entries. Reversing entries are they're not required in accounting. A company can choose to use reversing entries or not. Choosing to make reversing entries prevents double charges. A reversing entry is used whenever an adjusting entry creates a balance in an asset or liability account that initially had a zero balance. Paying an installment note payable with accrued interest. It says on January 1st, we paid cash for the monthly payment on the long-term note payable, principal $1,722.33, plus an interest of $710.84 for a total of $2,433.17. All right, so first of all, we need to figure out how much we're reducing our principal. So we're going to take our payment amount, which is going to be that full $2,433.17. $710 of that was for interest, so we're going to subtract that interest. That means that we're paying $1,722.33 on principal. Now, that was listed for us there, okay? When we record that, we are making a payment, so it's going to go into our cash payments journal. We're going to credit cash for the full amount, and we're going to debit long-term notes payable for the principal and debit interest expense for the amount of interest. The adjusting entries for accrued revenue and accrued expenses must be recorded at the end of a fiscal period in order for the financial statements to be accurate. Each accrual entry affects a balance sheet account and an income statement account. If an accrual entry is not recorded, both the balance sheet and the income statement will be incorrect. Excuse me. Number one, which accounting concept is being applied when an adjusting entry is made at the end of the fiscal period to record accrued revenue? That would be our realization of revenue. Number two, why does a business use reversing entries as part of its procedures for accounting for accrued interest expense? Remember, reverse entries are not required. So why would a business use it? They use it to avoid the inconvenience of determining how much, if any, of each cash payment is for interest income incurred and accrued during the previous year, and how much is incurred in the current year. You can go ahead and move on to 21-1, work together.